Traditional collective investment schemes, like mutual funds and unit trusts, are built on a very simple premise. They gather capital to buy a slice of the broader market. The return you get is tied to the standard market exposure, known as beta. This reliance on beta creates a structural vulnerability. When the broader market takes a dive, the passive portfolio follows the descent exactly. To break out of this binary relationship, financial engineers created what the industry classifies as other investment vehicles. These tools step outside standard long-only exposure, stabilizing the line by restructuring the math. These vehicles operate as mechanically engineered structures. By layering derivatives, precise legal wrappers, and leverage, institutional architects can deconstruct standard financial risks and reassemble them. They isolate the specific exposures they want while neutralizing the ones they don't, achieving outcomes that traditional portfolios cannot reach. To understand these tools, we must stop viewing investments as monolithic assets and instead examine the mechanics of how these structures actually work. A structured product is a packaged investment that typically combines traditional bonds with derivatives. It allows an investor to express a very specific, short to medium-term market view that standard securities cannot capture. Let's deconstruct exactly how that math operates. We'll start with a theoretical investment of £1,000. The investor wants total protection against capital loss, but still wants to participate if the stock market goes up. To guarantee the principal, the financial institution takes the majority of that capital, say £800, and uses it to purchase a zero-coupon bond. A zero-coupon bond pays no periodic interest. Instead, it is sold at a discount to its face value. Over a set time frame, like 5 years, that £800 mathematically matures to equal the full original £1,000 investment. The capital is now protected. The remaining £200 is deployed into the derivatives market. The institution buys a long call option on an index, like the FTSE 100. This provides exposure to the market's growth without risking any further capital. If the index drops, the option expires worthless, but the zero-coupon bond repays the initial £1,000. If the index rises, the investor gets their principal back, plus the specific upside yielded by the call option. This table details the varying structures these products take. While structured deposits and capital-protected products prioritize safety, investors chasing higher yields might opt for structured capital-at-risk products, or SCARPs, which reduce or remove the capital guarantee in exchange for higher potential returns. But structural certainty has a catch. That capital guarantee is a promise made by the issuing financial institution. If that bank's balance sheet fails, the product fails with it. The protection is only as strong as the issuer's solvency. Hedge funds carry a reputation for aggressive speculation, yet in their original design, they were engineered to do the exact opposite. They sought to eliminate market risk entirely. Granted, many modern funds do take massive directional bets. Global macro strategies, like those of George Soros, seek profit from massive trends across broad asset classes. Because hedge funds are structured as unregulated collective investment schemes, they aren't bound by the strict constraints placed on mutual funds. They are legally permitted to employ extreme leverage, aggressive short selling, and complex arbitrage. We can group these highly flexible tools into 3 broad strategies: directional, event-driven, and non-directional. To see how a fund engineers risk away, we have to look at non-directional strategies, specifically market-neutral equity arbitrage. Here, the goal is to systematically strip out market beta. A manager executes a paired trade using 2 highly correlated securities.
They might take a long position in one major oil company, like BP, while simultaneously taking a short position against a competitor, like Shell. If the entire energy sector collapses, the losses on the long position are offset by the gains on the short position. The broad market beta mathematically cancels out, leaving only the narrow performance difference. The manager has isolated pure stock-picking skill, known as alpha. But engineering absolute returns requires an aggressive operating environment. Investors face high barriers, massive minimums, strict lock-in periods, and steep performance fees. Private equity uses different mechanics, explicitly engineering its returns by trading away liquidity. The process begins with pooling. Large institutional investors commit capital, which is gathered into a central vehicle, usually structured as a limited partnership. Unlike public shares which trade daily, this capital is strictly locked. By removing the ability to withdraw funds on demand, the underlying business is completely separated from the panic and volatility of public stock markets. This allows the private equity firm to assume the risk of failure alongside company management. They deploy the capital over a medium to long-term horizon to restructure the company or drive aggressive growth, immune to quarterly earnings pressure. Returns are generated exclusively upon a capital exit. This occurs when the firm sells the shares to another business in a trade sale, sells back to management in a buyout, or achieves a public stock market listing. Investors endure this rigid, illiquid structure for one reason: to capture the illiquidity premium. This is the excess return they demand as direct compensation for surrendering the ability to sell their stake on demand. Islamic finance forbids riba, the charging of interest, and gharar, which is excessive uncertainty or risk. A traditional bond relies entirely on charging interest, making it completely unusable under Sharia law. The sukuk bypasses debt entirely by linking capital directly to tangible physical assets. This is the crucial legal distinction. These certificates do not represent a debt obligation. They represent an actual, undivided ownership interest in the physical asset. To see how this routing works, we can look at the common sukuk al-ijara structure. First, the originator, the company needing capital, transfers a physical asset, like real estate or aircraft, to a special purpose vehicle, or SPV. The SPV then issues sukuk certificates to the investors. In exchange, the investors provide the capital. The asset is then leased back to the originator for a specified term. Because the investors own the asset, they are entitled to receive the rent generated by the lease, routed through the SPV. They are earning rent, not interest. Through highly specific legal engineering, this structure mimics the predictable, periodic yield of a conventional bond, while remaining an equity-based, asset-backed transaction that complies with religious law. Alternative investment vehicles possess no inherent magic. They are precise mechanical responses designed to bypass specific financial constraints. Whether stripping out market beta, securing principal with bonds, trading liquidity for long-term growth, or restructuring ownership to avoid debt, it all comes down to mechanics. Every structural intervention carries a trade-off. Moving risk away from the price of the asset inevitably creates a vulnerability elsewhere. In exchange for structured outcomes, investors must absorb severe trade-offs: massive illiquidity lock-ins, exceptionally steep performance fees, and critical exposure to counterparty default. True financial sophistication is not about blindly pursuing higher risk for higher reward. It is about having the mechanical knowledge to choose exactly which risks to engineer out of a portfolio and exactly which risks to keep.